a broker for 22 and a half years, and I have been with the correspondent lender, NFM Lending, for the past 6 years. And primary business is 75% is my realtor business and past clients. So I've never seen anything like this, Lisa. And first of all, to your point of the absorption rate right now, I have to tell you, I am shocked. Last Monday, we got one lead. Like we are ramping up for a slowdown, right? Yesterday, Lisa, we got 10, these aren't refi leads, new pre-qual buyer leads yesterday, Lisa, 10.
Wow.
Yeah.
What's your typical like? So what's that like as a comparison? So if you got 10
as a comparison, my team and we're going to talk about capacity issues in a moment, because that is part of the reason we're seeing what we're seeing, the volatility, liquidity issues. But my team, our goal is 35 a week. So, 7 a day ish. So
wow.
10 during this COVID-19 pandemic, I'm actually shocked. And it wasn't just yesterday, and it's not just me, it's my other loan officers are also busy. So now I do have colleagues in other parts of the country that it is not like that at all, because it is not deemed an essential business in some states. So we are very, very fortunate that we are, Lisa.
That's amazing. Okay, so that's an interesting comparison, because 10 in one day versus 35 in 1 week. Yeah, okay, so, I can speak for myself, right? You have kids, they're grown at this moment. I have children that are living inside my house. I know other people that have the same scenario where they've got children in the house, or even grown kids that have come back to stay. They might be coming out of college. That, for me, when I look at the situation that we're all living in our homes, it could mean I've lived in my home right now, and I am really kind of over where I'm at. Sometimes we can kind of just deal with, it's kind of good, it's fine, I can live with it. I think maybe we'll see like the demand of how people are tired of living of just like ho-hum, like, okay, I'll deal with it. Maybe this forces a change agent for the buy side, for them to say, you know what, okay, enough, we're gonna make a change here. I don't know.
I could totally agree, and I've heard that sentiment from many agents and many people as we're all adapting to a different way of doing business, right? Remote. We had to set up our teams remote. I am still in my office. There's just myself and my marketing director, staying safe, staying 6 feet apart. However, I am hearing that from a lot of people, Lisa, and people that have had to adjust to, like you said, you've got children at home. I can't even imagine having children at home and working. So I commend you. But I agree that there's going to be a lot of pent up demand for people that want to move.
Yeah, that's an interesting perspective that we can see. Okay, does that really kind of stick? Or is that a short-term phenomenon? I don't know. If we had crystal balls, we would be incredibly wealthy and not be doing probably, virtual events at this point. But let's go on and let's talk about the key issues that are affecting lending right now, because the title of this event was Liquidity and Lending in the Real Estate Residential World. So I know that many people have come to me and they have said, oh, lending is so cheap right now, it's almost free, right? Because they remember about a month ago when the feds came out and basically lowered the Fed fund rate to 0. And they thought, wow, this is miraculous. I'm sure you've heard similar things. I'm trying to give a perspective to the reality of what did that really mean? How has it impacted the ability for people to buy at this particular market? What's the lending side of the story? Can you elaborate on what, I guess let's peel back the onion. Fed funds lower the rate to 0. What's that really mean?
Let's start with that, and then I'll answer your question of how it affects. So Lisa, we and this is even pre-COVID, whenever the feds, this is an ongoing, people think logically, they do something else for a living, that every time the feds lower the fund rate, they think mortgage rates are going down. So the difference between the feds fund rate, the feds fund rate is just the overnight rate per se. It's the rate that banks lend each other money on for liquidity, totally separate from mortgage rates, which are typically controlled by mortgage-backed securities. So if you look at, and I don't know, Lisa, are you able to show, just so I can put in perspective, people can see this. Are you able to show the graph?
I'll put that up for you.
Okay.
Yeah, we're seeing primary mortgage market survey from Freddie Mac. Okay.
Okay, so just so you understand, if you look at, so basically Sunday, March 15th, Sunday night, which actually was, it was actually when the feds, as you alluded to, lowered the fed's fund rate down to 0, okay? Phone is ringing off the wall for you and I and every agent out there, every lender out there. But if you look at this graph, Lisa, actually on March 12th, so a few days before, I locked in the lowest rates I have ever seen in my 29-year career, and to my understanding and from my research, the lowest rates in history. We were actually, if you can see here, I was actually locking in 15-year fixed rates at 2.625, 30-year rates at about 3.125. So look then fast forward to literally a week later, Lisa, right? A week later, rates literally went from there to 30-year fixed rates were at 4.5% with points.
Wow.
Wow, right? And then, so let me explain to answer your question, and then we can see rates are phenomenal and you can see where they've gone. So what happened is there's about 11 trillion dollars in loans out there, right? The industry has the capacity for about 2 to 2.5 trillion originations a year. So there's about 5 trillion in loans that when rates drop down here could refinance for all different reasons, lower their interest rate, lower their term, pay off debt, basically put themselves in a better future financial position. So you look at 5 trillion loans that all of a sudden people are locking in loans like crazy, right? Trying to capture those rates. I don't even know how many loans were locked in the industry, but just an enormous amount. So what happened, Lisa, is like anything, that caused major capacity issues, right? So you have two things. You have capacity issues, and then what happened is it caused, then rates shot up, and so it caused liquidity issues from the standpoint of the investor. So you've got these rates locked in at historical low, and then everybody's been hearing, I think you probably have, about the servicers, right? So the servicer services the loan, and they have to pay the investor, right? So what happened was there's all these, you're hearing margin calls, right? So margin calls with lenders. So and because what's happening,
I know what you're talking about, but I bet you the general population does not. So
go ahead, you ask the question, I'll answer you.
yeah. So a couple things you just said. So I bet you if you're thinking about this and you're watching this, you're thinking, what's the capacity problem? Because change of interest rate, lowest rates in history, you have a surge, you already had locked a bunch of loans, then you had a real surge, your phone was ringing off the hook with a 0% Fed fund rate. People think, oh my gosh, this is the time, this is the time. Then we have capacity issues. Who has the capacity issue? Is it you guys that are the the frontline people? Is it the bank who has, you know, a big pot of money to lend and it's not there available? What's the capacity issue?
Okay, so the capacity issue has to do with the warehouse lines. So you have lenders that have warehouse lines that they hold their mortgages on, and then they sell them off in bundles. They sell them off as mortgage-backed securities, right, to the investor. Well, they have to move those off the line, free up the lines in order to take in new originations. So what happened was there again, you had, when I say the margin calls, because it probably is going a little deep, has to do with hedging. So when it's like if you think of it this way, if you personally have your stock portfolio margined, right? Okay. And your stock portfolio falls, they're going to call that loan due, right? So that's pretty much what happened. They couldn't deliver off of the line. They couldn't get enough. And this is just industry wide. This is everyone, not the banks, but this is any correspondent lender that is selling to Fannie, Freddie, to the aggregates. So, so what happens is, because of that, the margins go down, and then they needed more liquidity they needed more liquidity into the markets. So when then fast forward, we're talking about forbearance comes in this crazy time here. So they're talking about people not having to make their mortgage payments. So again, I'm sorry, I'm jumping around, but to try to make you understand it. So you're not going to make your mortgage payments to the servicer, right? Because now they're giving you a 3-month or a 6-month forbearance. So all those loans that we were going to sell, nobody wants to buy them. Everybody stopped buying, Lisa. Everyone stopped buying. And that's when you saw this peak, because the risk was so high. So everyone stopped buying, and then hence the Fed stepped in, right, and said they started buying a couple weeks ago. So if you look back, you don't need to do it now, but if you look back at that graph, then you saw rates starting to come back down. Does that make sense?
That's great.
It's a lot to absorb. It's a lot to absorb.
Right. So I'm getting my mind wrapped around that, because that is so complex.
It's so complex.
You know, these margin calls and sort of the warehouse lines, and I'm thinking through the confluence of all of that, right?
Hey, Lisa, I apologize.
Yeah, it's fine.
I need to repeat some things back. Hi, Jane. Sometimes for me to grasp them, because I didn't grow up in this world of finance, so it's a foreign world with some interesting terms. If you could, for me, Jane or Lisa, if I understand it correctly, basically, you know, businesses are set up to make profit on loans, and then they trade them, and then they only have so much money to go buy more, and this got thrown out of whack by the rates flooding the market and taking up all the available. When you say liquidity, that means the cash? Do I have that right? Or
yes, but let me add this. So you have that's the one piece, Matt. The answer is yes. However, the other piece is COVID. Okay, so then people start losing their jobs, right? So that people start losing their jobs, and you have loans, let's say loans that closed in December, January, February. So if somebody closed in February, they haven't even made a first payment. So all these mortgage-backed securities. So now the investors that were going to buy these, they don't want them, because the risk is so high that there could be a first payment default.
so they're running to a different investment, basically, away from mortgages.
Well, that's what happened.
Okay.
No one was buying mortgage-backed securities.
Ah,
And that's
okay.
that day, we're looking at that graph, Matt.
Okay.
That's what happened. No one. So it was like, oh my God, no one's buying them. Everyone's warehouse lines are full,
Got it.
right?
Yeah.
And then you take the piece. So I'm thank you for asking that. Where
That
the,
created the upslope in that graph.
exactly,
Okay.
that's exactly right. And
Very
then
simple.
think about this piece. So the servicers, that is probably somebody servicing your mortgage. So the servicers, even though I'm not going to make my mortgage payment because I lost my job and I qualified for forbearance, I'm not making my payment to the servicer, but the servicer still has to make that full payment to the investor.
Right.
Yeah.
Right.
That
Right.
makes
Okay.
Yes.
So that's pulling down liquidity as well.
Oh, it's pulling down liquidity too. That's hence all these margin calls, and it has been a roller coaster. Yeah.
And that's, is it still trending? Is it still dropping, or is it starting to?
Um, so right now what we're waiting for, and I think it's supposed to be announced like by tomorrow. I mean, every day is something different. And then we'll get to some of the things that Fannie and Freddie that affect your buyers, uh, and what we can workarounds. But that's what we're waiting for. That piece is okay. So we got the CARE Acts. We took care of people that needed the PPI loan, right? So that, or PPP, sorry, PPP loan. So that came out, right? Now we're waiting for that relief for the servicers. So that's right, so that we can get back to some normalcy.
So probably
So
an additional month maybe, or could continue to slide on the liquidity being low.
It could, Matt. Absolutely. That's over my head. I'm trying
Right.
so hard. It's day by day. Like I'm just blown away sometimes by what's coming out, but
Mhm.
it certainly could, Matt. It certainly could.
Okay. Thank you guys. Sorry to take you off track there.
No, thank you. I needed that.
yeah, thank you for clarifying that, Matt. So did I understand that correctly in that there's a sort of governmental effort going on to help get the servicer relief so that they don't have to make those payments even though the
Absolutely.
forbearance
That'd be another more trillions in relief that's gonna help this. There has to be help the servicers, because it's one of those unintended consequences. They jumped in, they did what they thought they needed to do with forbearance, but not thinking, or not, that again, the unintended consequences with the servicers, what that was going to do. And it's sad. I mean, you've seen some lenders couldn't come up with the margin calls. They couldn't raise the money. So you've seen some go out, and as Matt alluded to, we may see more. And what that does for you guys in the lending industry, if all of us local, lenders and correspondents were out of business, your only option would be big banks, period. Ugh. I know. Thank you.
and the world is crazy. Wow. That's so fascinating. So thank you for that. I'm very clear personally on like how that's impacting us, but that's interesting that the feds are going to intervene, hopefully, and be able to give some relief to the servicer, which is kind of the middleman, which is kind of getting the squeeze.
Exactly. That's it.
Okay. And just so everyone's clear about servicing versus mortgage, right? You're an originator, you originate loans. Those loans are likely sold to another entity or even processed originally with an entity. And those servicing rights, can you explain that? Because a lot of people don't understand servicing rights and why when I closed with NFM Lending, what happened to my loan? And now I'm dealing with, Schmeck and Clip servicer out of Dallas, Texas.
Which is even with a lot of the banks sell the servicing rights. So that's just another revenue generating business, right? So the servicer is the one that basically that's all they do is they service. So they make money on the servicing. So just so you can even understand a little bit more. So to break even on, let's say, so the loan, a servicer buys a bulk of mortgages. They need about three and a half years to break even on servicing that loan for what they paid for that bulk of money. Okay. So another thing you think about, when rates went down so low, right? Then they've got loans in there that they've only had for 6 months, Lisa. I was refinancing people that I closed 6 months ago. So look at the money they lost because these loans are being refinanced out of these, we say high rates, but I mean, in the fours, right? And so that's another huge problem for the servicers.
Yikes. Okay. All right. So let's go to happier times. So back to demand. Demand is still there. Okay, that's good. Let's talk about what's possible right now. So you're lending right now daily. Tell us about your world and kind of how you're operating, and have any of these issues impacted you, and is there any special spots where they have impacted you? But anyway, what's happening in your world aside from applications and people trying to originate on loans?
So they've impacted us and all correspondents on a couple fronts. One, jumbo financing, which many of you have heard. I have had more calls with people saying there is no more jumbo financing. Well, there is, however, as you know, and you and I have one right now, what's happened is there's no appetite. Nobody, they don't, like I was placing a lot of my jumbo loans with Wells Fargo, right? That way you get the best of both worlds. You get our great service, the client gets the great rate, and then Wells Fargo buys that loan. Well, they've stepped out. They don't want the jumbos anymore due to all these issues. So it has affected the jumbo market, but the great news is there are still banks out there, and anybody can call me. I'll leave my number at the end, that you're just going to have to go to a banker right now to get a good jumbo rate. I do have 2 investors left, but the rates are ridiculous, and it's not something I would ever do. So it's affected that. Fortunately, a lot of our business is not jumbo business. And then the other, and again, for me personally and for our company, it's government financing. So as you're probably still seeing, again, those are the riskiest loans because a lot of lenders, this was about a couple of weeks ago on a Thursday, we went from being able to do a 580 credit score on an FHA, Lisa, where we now need a 660, 2 months reserves. Why? Nobody wants that. There's too much risk, right? Because we still don't know how many people are going to lose their jobs, right? I mean, things are looking better, I think, for Corona, but there's so much risk there because the FHA borrower typically has no reserves. So you lose your job, okay, you get 3-month forbearance, but then let's say you still don't have a job. So it has affected that. However, we now are pulling and selling. We're not selling to an aggregate, we are selling direct to Ginnie Mae, and we will have that good pricing and lower credit scores back in, don't quote me exactly, but should be 2 to 3 weeks. So that's the good news. Lisa, conventional financing, you saw the rates. Look again. I mean, yesterday we were locking in the 3.375, 3.5 on a 30-year fix. So rates are still phenomenal. We're still able to close a purchase loan in 30 days. We are prioritizing purchases, Lisa.
Okay. All right. So that's good to know. Looks like we have a question from Matt.
Hey, sorry, more questions for me. Real quick on the jumbos limit, just to refresh my memory, where has it been?
Yeah. So the conforming loan limit caps in our area, Hillsborough, Pasco, Pinellas, at 510,400.
Okay.
And Matt, on that, and then I love your questions. Here's another great option that we're doing and still able to do, because prior COVID, we had great 10% down jumbo money, gone. All that's gone, right? That's gone. So we're still able to do, and I speak for myself, an 80-10-10. So a borrower's buying a 758, whatever, $100,000 property. I can do a 510 first and then a second mortgage. So that's still very
That's
positive.
still working.
Yes.
Thank you.
Okay, that's good to know. Way around the jumbo market there. Give us a perspective. So Wells Fargo, big name in the world. Seems like, wow, if they're saying no to jumbo product and jumbo loan, I mean, how big are they in the scheme of things in the jumbo lending market?
Well, Lisa, and I believe, and I don't know this for sure, I can tell you, you still may be able, and I don't know this, to go to a bank, Wells Fargo, on the portfolio side. I don't know. I've heard they pull, I haven't been able to get an answer to that. However, like you can go to I know you can go to a Iberia bank and still get a jumbo loan. So yeah, it's
more control over it, or
I'm sorry.
They want more control over it, or what? What do you think? Because as opposed to going to the correspondent route, like through you, is it a control thing, or?
There's two different channels there. If they do it, like let's just use Iberia because I know that for a fact. Like they're holding it. They are not selling that mortgage, right? They're holding it, like, so, and they don't, even Bank of Tampa, who is a great partner of mine, I refer a lot to them. They refer a lot to me. Personal bank. Had nothing to do with COVID, but there's a loan that I could not do. It just did not meet Fannie guidelines, and they're able to do it with 20% down, of course, because they don't have to sell that loan, Lisa.
Gotcha. And so for those who do not know, in order to sell a loan, it has to meet certain criteria for that loan to be of a certain grade of paper, mostly A paper, so.
And some of the positives, I think that, if you look at again, like, look how fast, I mean, some say fast, some say it wasn't fast enough, but like, look like at the react, like, so for instance, like appraisals, right? So look how quick Fannie Mae responded to, I mean, we had appraisal that people don't want to let anybody in their house. They don't want the appraiser in their house unless it's a vacant property. Not all, but many. So they jumped in and said, okay, we'll accept drive-by appraisals, right? So you didn't know that? Yeah. So we had to have a workaround for that. The IRS is shut down. As you said today, we always usually think about the April 15th, but it's out of our brains now. The IRS shut down. So, so for Fannie Mae, if you look at the reason that Fannie Mae sends, we get what's called a 4506T on every file to validate income, right? I mean, because that in the last debacle, fraud is, is huge. So what they allowed is they allowed the borrowers to go pull their own 4506T. So even though the IRS is shut down, so we're walking our borrowers through. They can go online, and they're accepting that. So coming out with workarounds. The one that I think they haven't been able to solve yet, is just e-sign for everything. There's that, they're still working on that. And if they get that through, then that may change the way, we do business in the future. I don't know about you guys, but I'm sure you're seeing the same thing I am. 98% of the title companies have been fabulous with just, signing on the hood of a car, putting out a table, wearing masks. I mean, everybody's doing their best. So to continue to close loans and sales for you guys.
Yep. Most people need a place to live. You know, we have some clients now that they absolutely need to sell their properties. It's not a question mark for them. And, you know, being able to service them and the people that want to buy those properties is so critical because, you know, it can put a financial strain on people and their families unduly. I mean, it was already a strain to carry, you know, in one instance, 2 mortgages that are pretty hefty. And, you know, the strategy was to, you know, put this other house on the market and sell it. After they had moved, they did that, and now they got caught in this crunch. So, you know, while, you know, we're thankful that we are still considered an essential service because it's hopefully going to help families mitigate, you know, issues like that where they really do need a solution out of where they are, you know, holding a mortgage, for example, or families that have a baby. We just closed on a house last week where the family, they were getting ready to have a baby and they wanted to have their nursery set up and things like that. So still it's necessity for a lot of people to have a roof over their heads, and a lot of them want to do that in their own way that they can own. So I found this really helpful, and I appreciate you taking the time and giving us a lot of insight that's behind the scenes information that most people probably just don't realize or know. At this time, I think information is key to dispel a lot of the myths and the rumors and just, you know, things that are kind of out in the ether that really aren't true. So we have the real truth from you. So I appreciate your time so much, Jane.
Thank you. I'm going to leave you with one last thought. It's really imperative that all of you call. If it's your listing, call the lenders. If you've got a buyer with another pre-approval and they're not using us, call them, because what I'm finding is you're seeing this, which negative marketing, like, oh, did you see that so-and-so had a margin call and so-and-so, you know, everybody has their own overlays right now. So, and that's okay. They all have their own risk tolerance and what they feel they have to do to deliver. So just call. Everyone's different, and make sure that you know exactly what you're dealing with a borrower and their job and how that particular lender is handling the situation.
Good advice. Good advice. And one last question is, what do you see interest rates doing in the next 3 to 4 months, considering we had such a crazy situation in the last couple of months? What do you see happening if you had to predict? I won't hold you to it.
It's my prediction. It's my feeling. I think they are going to stay low, Lisa, and we may even see a little bit lower, but definitely stay low.
Good. Awesome.
Yep.
All right. Well, how do people get in touch with you?
My phone number is area code 813-758-8334. And my email is jfloyd@nfmlending.com.
Okay, awesome. Jane's fabulous. If you have any questions further, you can always reach out to her directly, or you can send me a text or an email. Happy to get those over to Jane to get your questions answered. I so appreciate your time today, Jane. Happy foraging through the lending sphere that you're in, and thanks as always for your time today.
Thank you all. Appreciate it. Have a great afternoon.
Thank you.